Okay, we are on some travel this weekend and not able to coordinate the recording, so I am going to go through the podcast presentation. So, this week, weekly economic highlights. The big news, of course, of the week is the government shutdown. We'll take a look at what the charts say, how government shutdowns have affected the stock market, particularly the TSP C fund in the past. It's the end of the month, so we'll take a look at the monthly candle charts and the TSP fund direction. Okay, so first, weekly economic highlights. This is the Case-Shiller Home Price year-over-year index. So as long as this line is above zero, home prices are increasing year over year. So while the line is coming down, it means the increase is decreasing, okay? But as long as the blue line is above the zero line, prices are actually going up. The importance of the chart is that since early 2024, the trend of the increase has been declining. And it's at the lowest point it's been in quite a while. The increase was only 1.8% year over year as of the end of September. So good news for people looking to get into houses. Home prices aren't necessarily coming down. This is obviously a nationwide number. They certainly are coming down in some parts of the country, but overall they're increasing less. Okay, as we've been talking about now for several months, bond auctions that happen every week the yield that the government has been having to give investors to buy bonds has been decreasing, which is good because the less yield the government has to pay, it's the less interest that the government pays on those bonds, and so it doesn't add to the deficit as much, right? But this is the first week that we've actually seen a little bit of a change. Some bond auction rates went up this week for the first time in months. So the yield on the 3-month stayed flat. It was the same as it was last week. The 6-month actually went up. So the government ended up paying more for more interest to investors who bought 6-month bonds this week than they did last week. And then 1-year bonds were actually up a little bit also. So a little bit of a change, and that kind of goes along with the chart that we've been talking about here for the last 2 weeks. So this is a chart of the 10-year Treasury yield, okay? This was September 18th, 2024, was the first time the Fed cut rates since rates bottomed in 2020. And as you can see, rates had been coming down. The 10-year yield had been coming down before the Fed cut rates, and then when the Fed actually did cut rates, yields started going back up, right? That's the bond market telling the Fed that they don't agree with this idea of cutting rates. So we were interested in seeing if the same thing was going to happen on September 17th of this year, right? 2 weeks ago when the Fed cut rates by a quarter basis point, or by 25 basis points, by a 0.25%. So initially, for about 2 weeks, yield moved higher, right? Just like it did in September last year. But since then, this week, yield has rolled over. And this move higher only brought yields to the downsloping trend line. So we got resistance at the trend line and yield rolled over, which, it's not confirmed until we get below this low, right? But for now, it looks like the bond market is agreeing with the Fed and rates are going to continue to go lower. So last week we put up this slide, right? 30-year mortgage rate fell from 6.39 to 6.34% for the week, while the rate on the 30-year bond continued to rise after the Fed had cut rates last week. This was this rise in rates, okay? So we said we should expect mortgage rates to begin moving higher. And so what happened? This week, the 30-year mortgage rose to 6.46% from that 6.34% last week. Now, the data is a week late, right? So the downtrend in rates is it confirming the 10-year yield chart. So this is the data that was used for last week, right? And rates were going up, which is why mortgage rates went up. Now rates are coming back down. So if they continue down, right, we should expect mortgage rates to begin, wrong one, we should expect mortgage rates to begin moving lower now, okay? So this data is a week behind, and so it pays to pay attention to what is actually happening on the chart. Okay, the next Fed meeting is October 28th and 29th. There'll be an interest rate announcement on the 29th of October. The Fed is expected to cut rates by another 25 percentage points. The cut is expected due to continued concerns of weakness in the labor market, and the intention is to lower borrowing costs to encourage hiring, right? And this is consistent with the bond market reaction since the last September rate cut, because now the bond market is agreeing with the Fed, and it looks like the trend in the downtrend in yield will continue, okay? That is a positive for the F fund. As yields move down, the F fund goes up. Okay, so the big news for the week was the government shutdown. So this was a great article at realinvestmentadvice.com. It listed all the government shutdowns from longest to shortest since 1976. And I chopped out the longest 4 government shutdowns since 1976. So you would think that the longer the government shutdown, the more impact it would have on the market. Okay, so let's just take a quick look through those 4 government shutdown periods and see if we can kind of think through what the current shutdown how it might affect the C fund. So this was the longest government shutdown, was December 2018, okay? We had already peaked in 2018, and we had this A, B, C corrective decline in late 2018. So the shutdown happened, on the 21st of December. We only had another day or two of market decline, bottomed, and then the market ripped out, right? Ripped to the upside. So did the government shutdown add to decline in the C fund in 2018, which was the longest government shutdown since 1976? No, you would argue that the government shutdown did not affect, because basically immediately the market turned around and went higher, okay? The second longest one was in 1995. We had a pretty strong run up, right, going into the government shutdown. It shut down, caused a little bit of volatility for a couple days, and then prices started to recover, hit the prior high, came down again, and again we have this ABC corrective pattern and another move higher of basically the same length, right? So this move higher, correction, move higher is all part of the same pattern. So again, if I was looking at this, I wouldn't really think that the government shutdown had much to do with that correction. It's possible that it did, but it certainly didn't have any catastrophic effect on the overall uptrend of the market, okay? And then the third one was in 1978, which was in the middle of a very tumultuous time for stocks as it was. We had a big run up earlier in that year. We had a pullback. This is where the government shut down, and we had an immediate rally, right? Kind of like what we had in 2018. And then stocks rolled over and put in, pretty significant lower lows. But again, it picked up the long-term trend line to move higher. So I don't know that I would contribute or attribute the government shutdown to this decline in stocks. And then finally, the fourth longest happened right here in 2013. And as you can see, the market continued down for a couple of days, but then picked up this very clear long-term uptrend line. And so if I'm looking at all four of these, I'm basically coming to the conclusion that the longest four government shutdowns since 1976 didn't have a whole lot of effect in the big scheme of things relative to the trend of the market. So we'll have to see, and if this week is any indication, it doesn't seem like the current shutdown is having much of an effect on the market as it is now. Okay, monthly candlesticks. So we get a chance 12 times a year to take a look at the big direction of the trend. So if we take a look at the C Fund, this is a 5-month moving average, this black line. As long as that black line is moving higher, the trend, the long-term trend, right, the monthly trend, each one of these ticks is 1 month of price movement. We're going all the way back here to the bottom in 2009. So we have been, this was the big reversal in April, and then the market has been trending higher. And every time it's pulled back a little bit, it's found support at that 5-month moving average line. So as long as we continue to hold support at that rising black 5-month moving average line, the trend continues higher in the big scheme of things. Okay. S Fund. So we peaked back here in 2021 in the S Fund, had a big dip in 2022, recovered into the end of 2024, just barely poked to new highs, had a bit of a pullback, a pretty big pullback into April, and then we're just now trying to break through that, it's 2,400 level on the S Fund. On a monthly basis, we're not quite through there yet. I mean, technically we are above that line, but if we get any kind of pullback, and particularly if we get below that rising 5-month moving average line, we will have put in a triple top, okay? But for right now, the trend is certainly up, and it looks like the S Fund wants to continue to move higher. I Fund. So I Fund's having another really strong month. It is just, this is back here in 2009. So it's not all that far above its long-term triple top on a monthly basis. You would certainly argue that it's looking very strong at this point. And as we've been talking about for a long time, if the dollar continues lower, the I Fund continues higher. Okay, the F Fund. So the F Fund, going back here to its inception in 2004, 2022 was an historic move down in bonds. All the gains that were made since the F Fund was established in late 2003, all those gains were wiped out in 2022, okay? So some people would argue that the F Fund, or bonds in general now, are extremely undervalued, okay, versus the stock funds because we've pulled so far back. But if we're looking at it from a technical analysis perspective, we came down in 1, 2, 3, 4, 5, a 5-wave down. And now we had an ABC recovery. And if the pattern continues, we should have a 1, 2, 3, 4, 5 to the downside. So that's an Elliott Wave analysis of the F Fund. If we get above the 102 level, that particular count will be voided out. But for now, the expectation or the bias is to the downside in bonds, which means interest rates move higher from here. Okay, so what is the kind of shorter term, the weekly chart, TSP Fund direction? So this is a weekly chart of the C Fund. This is the 20-week moving average line and relative strength and MACD. And so as you can see, as long as price is above that 20-week moving average line, when it comes back down and finds support there, right? Every time it finds support, it keeps moving higher until it breaks down through that 20-week moving average line, okay? Once we got back above it here in 2025, we've been in a very consistent up channel, okay? So there's not a whole lot to talk about in terms of fund direction, right? On both a monthly and a weekly basis, the C fund continues higher. Okay, if you like that kind of analysis and want more in-depth types of analysis and education that we have for our subscribers, check us out at growmytsp.com. Okay, that's all I got. If you guys have questions, please post them in the comments and we'll get to them. Have a great week.